Hello and welcome. Real estate has long been seen as a cornerstone of building wealth. The idea of owning property, collecting rent, and watching its value grow is incredibly appealing. But for most people, the barrier to entry is massive. You need a huge down payment, you have to deal with tenants and toilets, and all your money is tied up in a single asset. It's illiquid, it's management intensive, and for many, it's just out of reach. But what if you could get all the benefits of owning real estate: the income, the diversification, the potential for appreciation without any of the headaches? You can. The answer is REITs, and they are one of the most powerful yet misunderstood tools in an investor's toolkit. In this video, we're going to demystify REITs. We'll explain exactly what they are, how they work like magic to make you a real estate mogul, the different types you can invest in, and how to easily add them to your portfolio. Let's unlock this door together. So, what exactly is a REIT? The name stands for Real Estate Investment Trust. The easiest way to think about it is like a mutual fund, but for real estate. Imagine a company. Instead of making software or selling cars, this company's business is to own, and often operate, income producing real estate. They pool money from thousands of investors, people just like you and me, to buy a whole portfolio of properties, things like apartment buildings, shopping malls, hospitals, cell towers, and massive warehouses. When you buy a share of a REIT, you're not buying a physical piece of brick and mortar. You're buying a share of the company that owns all that brick and mortar. You become a mini landlord of a massive, professionally managed real estate portfolio. But there's a special rule that makes REITs so unique and powerful. To qualify as a REIT, a company is required by law to pay out at least 90% of its taxable income to shareholders in the form of dividends. This is why REITs are famous for their high dividend yields. They are legally designed to be income-producing machines. When you collect rent from tenants in an apartment complex you own, that's income. When you own a REIT that owns that same apartment complex, you get your share of that rent passed directly to you as a dividend. So, why would you want to add REITs to your portfolio? There are three compelling reasons: diversification, income, and accessibility. First, diversification. Real estate as an asset class often behaves differently than stocks and bonds. When the stock market is volatile, the value of a physical, income-producing property might hold steady or even increase. By adding REITs to a portfolio of stocks and bonds, you're adding a new asset class that isn't perfectly correlated. This can smooth out your returns and reduce your overall risk. You're not just diversified across different companies. You're diversified across entire sectors of the economy. Second, high dividend income. This is the main attraction for many investors. Because of that 90% payout rule we mentioned, REITs typically offer much higher dividend yields than the average stock. This can be a fantastic source of passive income, especially for retirees or anyone seeking cash flow from their investments. And third, accessibility and liquidity. This is the real game changer. With a REIT, you can become a real estate investor for the price of a single share, often somewhere between $50 and $200. There's no mortgage to get, no property management, and no dealing with midnight phone calls about a broken water heater. Best of all, REITs are traded on major stock exchanges, just like shares of Apple or Microsoft. This means you can buy or sell your entire real estate position with just a click of a button. It's real estate investing, but with the liquidity of a stock. Now, it's important to know that not all REITs are the same. They come in different flavors, which allows you to invest in specific parts of the real estate market that you find interesting. First, you have equity REITs. These are the most common type. They own and operate physical properties. Think of apartment complexes like Bay, shopping centers like Simon Property Group, office buildings like Boston Properties, or industrial warehouses like Prologis. When you invest in an equity REIT, you make money from two sources: the rent collected and the potential appreciation of the properties themselves. Next, there are mortgage REITs or MREITs. These REITs don't own physical properties. Instead, they provide financing for real estate by purchasing or originating mortgages and mortgage-backed securities. They make their money on the interest spread, the difference between the interest they earn on their mortgage assets and the cost of funding those assets. MREITs are generally more complex, more sensitive to interest rate changes, and are considered higher risk than equity REITs. For beginners, it's often best to start with the simpler equity REITs. Finally, there are specialized REITs. These focus on very specific and often very modern niches. This includes things like healthcare facilities, managed by REITs like Welltower, cell towers like American Tower, data centers like Digital Realty, and even timberland with companies like Weyerhaeuser. So, how do you actually invest? The easiest and most diversified way for a beginner to invest in REITs is through a real estate ETF or exchange-traded fund. Instead of trying to pick one specific REIT company and hoping it's a winner, you can buy a basket of them all at once. The most popular one is the Vanguard Real Estate ETF, ticker symbol VNQ. It holds over 150 different REITs, giving you instant diversification across the entire sector. You get the income and diversification benefits without the risk of picking a single loser. One important note for you to consider: because of their high dividends, REITs are generally most tax efficient when you hold them in a tax-advantaged account, like a Roth IRA or a traditional IRA. Inside these accounts, you won't have to pay taxes on those dividends each and every year, allowing your investment to compound more effectively. So let's do a quick recap. What is a REIT? It's a company that owns, operates, or finances income-producing real estate and is legally required to pay out most of its income as dividends. Why should you invest? For diversification away from traditional stocks and bonds, for high dividend income, and for the incredible accessibility of investing in real estate without the typical hassles of being a landlord. And how do you get started? Consider a low-cost REIT ETF like VNQ to get broad, diversified exposure with a single, simple purchase. REITs truly democratize real estate investing. They turn a traditionally exclusive, high-barrier asset class into something that anyone with a brokerage account can participate in. They allow you to build a portfolio that collects rent from malls, hospitals, and apartments all across the country, all while you sleep. It's a powerful way to build wealth and generate income, one brick or one share at a time. Thanks so much for watching. If you found this helpful, please give this video a like and subscribe for more content to help you on your investment journey.